All right, it's the penultimate video for chapter 7 and this module, and it's on net operating losses. So, obviously, you've gathered by now, presumably, that we measure taxable income over 1 year period increments. And, it's a little bit artificial, right? I mean, there's no reason that the period couldn't be 6 months or a quarter or 2 years or whatever it is, but it is a year. We think about it as being a tax year. And so what happens is, since when you're in a position where you have a loss, you don't get money back necessarily. Instead, you just have zero tax. The NOL is designed to help smooth out tax liability that might be associated with volatile earnings. So let's compare Jacob Corp, which has a very steady state of income, versus Man in Black, which has a volatile income stream. And we'll just assume a 30% tax rate just to make life easy to calculate. So you can see Jacob, 10,000 a year, right? Year 1, year 2, year 3, all 10,000, totals 30,000. With a 30% tax rate, they pay tax of 3,000, 3,000, 3,000 for a total of 9,000. But if you look at Men in Black, if it weren't for the NOL, they pay, they have 20,000 of income in year 1, so they pay 6,000 of tax. Then in year 2, they have a giant loss, so they pay no tax. Then in year 3, they're back to 25,000 and pay 7,500 in tax. So even though across the 3 years, you can see the total taxable income is the same, without a net operating loss provision, Men in Black is actually going to pay more in taxes over those 3 years. So because we want to try to create some horizontal equity across time, we have the NOL. So the NOL rules have changed. They were the same for years and years. Not forever, but for a long time. But recently they've undergone some significant changes. So first, let's start with what the rules are for an NOL in years 2017 and prior, tax year 2017 and prior. So in that era, NOLs could be carried back or forward. If you carry back, that just means you actually refile an amended return and you request a refund. And a carry forward means you use the NOL to reduce taxable income in a future year. It was available to both individuals and corporations. And you could carry it back 2 years and then forward up to 20 years. And as a general rule, you had to start with a carryback. You had to go back to the first year first. So if X Corp created an NOL in 2017, they would need to go back to 2015 first, then on to 2016, then carry forward if any left. So they couldn't just start with 2016 because they wanted to, but they could make an election to skip the carryback altogether and only use the carry forward. So for example, if you're a startup, you may not expect to make any money, and you haven't been making any money, so why carry it back, right? Just go right for the carry forward. Okay, so then Tax Cuts and Jobs Act hit 2018, said we're changing all the rules. So from now on, NOLs can only be carried forward, but they can be carried forward indefinitely. So there is no expiration on an NOL. The other change that was made is the 80% rule, which says you may not offset more than 80% of that current year income with an NOL. So let's do a quick example. Horcrux incurs an NOL of $50,000 in 2018. So then they generate taxable income of $40,000 in 2019. So they're like, oh, great. Well, I want to use our NOL to offset that 2019 income. But because the 80% rule, they can only offset 80% of 40,000 or 32,000. So they'll use 32,000 of that NOL, which would leave 18,000 to carry forward into 2020 and beyond. So let's say Horcrux generates taxable income of 20,000 in 2020. Well, 20,000 times 80% is 16. So they'd be able to offset 16,000 with their NOL, but the remaining 2,000 of NOL that's left, the 18 minus the 16, that would be carried forward again to a future year. And That was the plan, and it was going to be the plan for the foreseeable future, and this provision does not expire. However, then COVID hit. And we're not going to go through the COVID rules because they're largely all expired now. Instead, it's probably most important to just see where do we stand now. And so what you have to realize is that the NOL rule that applies is the rule that applied when the NOL was generated. So if for some reason a company had 2017 and prior NOLs, those are still 220, 2 carryback 20 forward NOLs, and you can offset 100% of the taxable income with those. Then we got into the window between 12/31/2017 and the end of 2020, and the rules changed because of COVID, but we're going to skip that because that's all past us now. And then we get to years after 2020, and we're back to those rules that we just discussed. No carryback, indefinite carry forward, 80% of taxable income. All right. So believe it or not, corporate NOLs are actually a little easier to deal with. That's probably not true. They're not easier to deal with. But a lot of people don't have experience with individual NOLs, and they do appear on the CPA exam. So we need to give them their time and their credit. And so the idea behind an individual NOL is supposed to be limited to business NOLs and not the deduction of non-business NOLs. So what this means is the NOL computation for individual taxpayers means we have to classify all our items as either business or non-business. And so what that means is your NOL simply isn't the taxable loss that you calculate. It's actually shown on the bottom of page 1. It's not on page 2. It's not the taxable loss that you might report on your 1040. It requires some additional work. Let's talk about what the additional work is. So what can your NOL include? Well, first, you don't get a deduction for an NOL from a different year because then you'd be double counting the NOL. You'd be carrying it forward or back and including it in the current year NOL, therefore unable to use it. Well, now you've doubled your NOL. So obviously, you don't get to double count your NOL. Non-business capital losses can only be used against non-business capital gains, which means that excess non-business capital losses cannot increase the NOL. Non-business deductions. So for example, itemized deductions can only be used against non-business income. So interest, dividends, etc. So like your investment income. However, if in the previous step, your non-business capital gains exceeded your non-business capital losses, then those excess non-business deductions can be offset against those gains. Careful note here, casualty losses are actually treated as a business deduction for NOL purposes. And then lastly, business capital losses can only be used against business capital gains, except that they can be used to offset non-business capital gains if one exists. Okay, let's do an example. Eugene is a single taxpayer, completed her 2021 Schedule C. Her net loss is $70,000. She's got wages of $45,000, interest income from her savings account of $500. Her business sold property during the year generated a $3,000 ordinary gain, and a separate $5,000 long-term capital gain. Eugene also had capital gains and losses from outside the business, right, from just the sale of stock investments. $17,000 short-term capital gain and a $6,000 long-term loss. Eugene itemizes her deductions. Schedule A has the following: taxes, $8,500, mortgage interest, $6,000, charitable gifts, $500, and a casualty loss of $2,500 for total itemized deductions of $17,500. So kind of the first step is to calculate taxable income. So we start with our wages, we add in the interest income, we take that business loss deduction of $70,000, then we net all the capital gains together, right, which I've footnoted here, to get $16,000 of net capital gains. There was that ordinary gain of $3,000, which leaves AGI of negative $5,500, less itemized deductions of $17,500 is a taxable loss of $23,000. But recall that does not represent her NOL. Instead, we need to bifurcate these items into their two pieces. So let's take each one of these items and classify it. So wages are considered business income. The interest income was just investment income, so that is non-business. Her business loss on her Schedule C was $70,000. That's, of course, business. The capital gains needed to be split into the two parts, so let's go back and look at those, right? We had a business long-term capital gain and then $11,000 of non-business capital gains. So we can put the 5 here and the 11 over here. Whoops, sorry. Then the ordinary gain was from the business, so that's $3,000. There's the casualty loss for the itemized deduction, and then all the other itemized deductions go over here. Okay, so recall that non-business deductions cannot exceed non-business income. So when we look at our non-business deductions, $15,000, they exceed our income by $3,500. So what that means is we need to take that $3,500 and add it back to our taxable income, which gives us an NOL of $19,500, which generally speaking will agree to the business NOL. Notice they are the same. All right, that brings us to the end of NOLs. One more video.